Welcome to the Deep Dive.
Great to be here.
Today we're tearing into the AST SpaceMobile Q3 2025 update.
Yeah, this one's fascinating. You've got this tension, right?
Exactly. A financial miss on one side, but just huge operational momentum on the other.
So our mission today, figure out what really counts when you're building something this big, literally in orbit.
It's that hyper-growth story playing out.
Totally. And for anyone tracking space, this report really highlights the dilemma.
How do you even evaluate them? Traditional company.
Or this massive infrastructure build-out machine, which is what they are right now.
Yeah.
The market seems to have picked its side, though.
Okay, let's start where the headlines did. Q3 financials. Period ending September 30th, 2025.
Right. So GAAP revenue,
Yeah.
the official number, came in at $14.7 million.
And that missed the Wall Street consensus?
It did, yeah. The estimate was $21.87 million.
So,
a miss.
and earnings per share, EPS.
Also a miss. Reported negative billabus of 450 cents per share. The estimate was negative $2.10, so $0.24 worse than expected.
So on paper, you look at that and it seems disappointing.
Definitely looks that way at first glance.
But where did that $14.7 million actually come from? It's not like people are using the service widely yet.
No, exactly. That revenue was driven by hitting milestones on U.S. government contracts and also delivering some of the ground infrastructure, the gateways.
Ah, so build-out revenue, not service revenue.
Precisely. Recognizing payments for, hitting specific project steps and delivering hardware, not phone calls yet.
Got it. But here's the bit the market seemed to latch on to.
This is key. Despite missing Q3 estimates.
They reiterated their guidance for the second half of 2025.
Yep. Still guiding $50 million to $75 million in revenue for the second half.
Wow. Okay, hold on. If they only did $14.7 million in Q3.
Right.
And they're sticking to that $50 to $75 million range for H2, that means they expect Q4 revenue to be at least $35 million, maybe over $60 million.
Exactly. That's a huge implied jump for Q4.
Given the Q3 miss, isn't that risky? Credibility-wise, what makes them so confident?
Well, it suggests they have some very specific high-value things they're certain will land before year-end.
Like what?
Probably big gateway deliveries getting finalized, or maybe significant U.S. government contract payments hitting the books.
So it's tied to concrete stuff already happening.
That's the read, yeah. It's not just wishful thinking. It explains why the stock didn't, fall off a cliff.
And the stock action really bears that out. As of the report date, November 10th.
Up big time.
Share price closed at $68.72. That's up over 41% in the last 3 months.
And over the last year.
177.5%. Just staggering.
So the market is definitely looking past the Q3 chap loss. It sees the infrastructure play.
Right. But building infrastructure costs money. A lot of money.
Which brings us to expenses. Total operating expenses. They jumped quite a bit.
How much?
Hit $94.4 million in Q3. That's up from $74.0 million in Q2.
A $20 million jump, quarter over quarter.
That's the burn rate you need for this kind of hypergrowth.
Where's that extra cash going?
It's basically funding the acceleration. You saw a $12.2 million increase in engineering services costs.
So R&D, design work.
Yeah. Testing, getting the Block 2 satellites ready for launch, locking down that design.
And the rest. About $5.5 million increase.
That was cost of gateway deliveries.
Yeah.
Which lines up directly with the revenue they recognize.
Plus cost of goods sold, basically, for the hardware.
Exactly. The cost of actually building out the network pieces on the ground, industrializing it.
Okay, so financials. Backward-looking noise, maybe. Let's pivot.
To the forward-looking engine. Commercial results.
And this is where it gets really, really interesting. Segment 2.
The big headline number.
Over $1 billion in aggregate contracted revenue commitments secured from partners.
That's the number. $1.0 billion. It's the real proof of demand.
It shows the carriers, the MNOs,
The Verizons, the Vodafones of the world.
they're willing to commit serious capital years ahead of full service.
They must see this as essential for plugging their coverage gaps. It's not a nice-to-have for them.
And a couple of specific deals really highlight this. First, Verizon.
Right. They firmed up that partnership from May 2024.
And the goal is ambitious, targeting a 100% geographical coverage in the continental U.S.
Just think about that. 100% geographic coverage. That's not just filling rural gaps anymore.
No, it sounds like national critical infrastructure.
Exactly. Think remote areas, sure, but also disaster recovery.
Yeah.
When cell towers go down, this keeps working.
Okay, then there's the STEC Troop Agreement.
Another big one. Covers Saudi Arabia, key markets in the Middle East, North Africa.
It's a 10-year deal. And this part stood out.
The prepayment.
Yeah, $175 million prepayment for future services.
That's just a massive vote of confidence. And it's cash now.
Which, for a company burning cash on satellites and launches...
It's incredibly valuable. It de-risks the timeline. It's non-dilutive funding, basically. Less pressure to tap into their other funding lines right away.
Huge signal. We also saw more government work.
Yep, a new prime contract award with the U.S. government. Still needs negotiation, but it's progress.
And that plan with Vodafone for a European constellation.
Still moving forward, using Germany as the satellite operations hub for the EU.
So when you add it all up,
you've got 50-plus MNO partners signed up globally,
covering nearly 3 billion potential subscribers.
The demand side looks really strong. The question shifts to supply. Can they build and launch fast enough?
Execution velocity.
Okay.
Let's go there. Segment 3, moving from contracts to actual operations.
This is where the rubber meets the road, or I guess satellite meets the rocket.
The multi-provider launch campaign, it's really kicking off now, moving from planning to doing.
And the cadence, the manufacturing and launch speed, that's everything right now.
First up, BlueBird 6.
Shipped to India already, launch targeted for the first half of December 2025, so very soon.
And BlueBird 7 is right behind it.
Expected to ship to the Cape Canaveral in November. Launch shortly after that.
So 2 launches, potentially back-to-back. This is the start of Block 2 deployment.
The moment everyone's been waiting for.
The near-term goal is pretty punchy.
Very. They're aiming for 5 orbital launches by the end of Q1 2026.
5 launches in, what, 4 months or so?
Yeah. But the bigger goal, the end of 2026 target.
That's the really eye-popping one.
Reaching 45 to 60 satellites in orbit by the end of next year.
Okay, 45 to 60. To hit that, they basically need to launch every 1 to 2 months, consistently, for a whole year.
It's an incredibly aggressive schedule, especially for a new space company scaling up.
So you have to ask yourself, right, is that timeline realistic? Or is it more aspirational, setting a high bar?
That's the key risk everyone's watching. But they do offer some reasons for their confidence.
Like the production progress.
Exactly. BlueBirds 8 through 19 are already being built, various stages of production.
And they mentioned something about Micron's equivalent.
Ah, right. They aim to finish assembling components for 40 satellites equivalent of Microns by early 2026.
Okay, break that down. Micron's equivalent, what is that?
It's sort of their internal term. Think of it as the complex, proprietary core components of the satellite. The brains, the communication guts, not the basic structure, but the really specialized hardware.
So having parts for 40 satellites ready early next year
means manufacturing isn't tied directly to the immediate next launch. They're building up inventory, deep inventory.
to feed that rapid launch cadence throughout 2026.
That's the idea. Decouple production from launch logistics, somewhat.
There was also an update on the tech itself, the ASIC,
The application-specific integrated circuit, their proprietary chip,
boasting up to 10 gigahertz of processing bandwidth.
which is huge. That ASIC is the magic that lets a regular phone talk to a satellite hundreds of miles up.
And they plan to integrate that.
First integration plan during Q1 2026. That's a critical engineering step before they could really scale up commercial service.
And speaking of service, it is starting, right? Even if limited.
Yeah, they confirmed initial service is active, nationwide intermittent service across the continental U.S.
Intermittent is the key word there.
For now, yes, but it proves the basic tech works. The phone-to-satellite link is real,
And future activations?
planned for Canada, Japan, Saudi Arabia, the UK in early 2026,
So the next step is moving from intermittent to continuous service.
which requires more satellites in orbit, which takes us back to money, capital.
Right. You can't launch dozens of satellites without a very strong balance sheet. Segment 4, capital structure.
And they look pretty well funded for this big push.
Cash position as of September 30th.
They had $1.2 billion in cash, cash equivalents, and restricted cash. A solid number.
But the total funding picture is even bigger.
Much bigger. They did that big convertible notes offering.
Raised $1.15 billion gross from new 10-year convertible senior notes. Why converts? Why that specific tool?
Well, convertible notes are kind of a hybrid debt, but with an option to convert to stock later.
So it's cheaper debt initially, lower interest.
Generally, yes, compared to straight debt. And it signals confidence in future stock growth. Lets them keep cash focused on building, not just interest payments right now.
Okay. And when you add those proceeds plus other facilities.
The capped call, the ATM facility.
Right, those things. What's the total liquidity?
Over $3.2 billion. That's the total cushion they've built up.
Can you quickly explain capped call and ATM facility for us? Sounds like finance jargon.
Sure, think of the cap call like insurance against the stock price going too high, which helps limit the dilution from the convertible notes eventually converting to shares. It protects existing shareholders somewhat.
Okay. And the ATM?
The ATM facility at the market offering lets them sell new shares gradually, directly into the market when they choose. It's like a flexible tap for cash, much less disruptive than one giant stock offering.
So layers of sophisticated funding designed for exactly this kind of long, expensive build-out.
Precisely. It allows them to run these gap losses during the heavy investment phase without running out of runway.
And they are definitely investing heavily.
Oh, yeah. They've already incurred about $1.2 billion in gross capitalized costs, that's satellite parts, launch contracts paid up front, building the factories.
They've spent the first billion plus.
And that $3.2 billion in liquidity shows they're funded for the next critical phase, getting those satellites launched.
Okay, let's wrap this deep dive. The Q3 numbers, the financials, they were a backward glance, a necessary cost of doing business at this scale.
Yeah, the JAP loss itself doesn't tell you much about where they're going.
The real story, the forward-looking metrics, are things like that $1.0 billion in commitments.
That $175 million cash prepayment from State Group. Huge validation.
And most importantly, that incredibly aggressive launch schedule. 45 to 60 satellites by the end of 2026.
Which really frames the whole thing, doesn't it? They are purely a deployment machine right now. They raised the money over $3.2 billion in liquidity.
So here's the final thought for you, the listener, to chew on.
Given everything, the funding, the contracts, the sheer focus on speed and scale is the only metric that truly matters for the next year. Simply hitting that launch cadence, hitting that 45 to 60 satellite goal by end of 2026.
And what happens if they don't? What if that schedule slips, even by just a couple of months? What are the ripple effects then?
That execution risk. That seems to be the absolute core variable right now. It defines everything.
Makes the next few operational updates maybe even more important than the earnings calls?
Absolutely. Watch the launch manifests.
Dive deeper into those sources yourself. We'll see you on the next deep dive.